Hi, thanks for joining us. Talk about investing in the worst of times. High inflation, high rate, higher for longer. Never mind some suggestions of a pivot by the Fed. And also you have multiple crises: climate, energy, debt. In fact, the IMF says debt is at an unbelievably crazy level, and it's impacting countries and people who can afford it the least. And also, we have geopolitics. US and China at odds over just about everything: trade, tech, Taiwan now. And if that's not enough, we also have technology that's disrupting just about everything. In fact, we had Amazon saying that, you know what, we're going to have smart robots taking over the jobs of our workers, and that's going to happen soon enough. So against that backdrop, a challenging backdrop, how do you invest? But you know what? If you've been around, you get a sense that that's a bit of optimism now. Is it misplaced? Let's get Jeff's perspective on this. That optimism that we're seeing in Davos right now, is that misplaced? Has it got to do with the fact that inflation is easing? Has it got to do with the fact that China has opened up?
Well, thanks very much, Haslinda. I think we are in an environment that's going to be volatile. I think it's going to be volatile because the timing of the lags in the effect of monetary policy, as well as the timing of inflation, when you kind of go year on year on something that went up 48% and so on. Unfortunately, the timing is not going to match. And so there will be times when it appears as if the Fed's probably won the war on inflation, and it'll look like it doesn't need to raise rates anymore, and the markets can rally. But then there are other underlying forces that could keep inflation. So headline inflation come down from the 9 down to the 5 or 4, and then suddenly you find that there are still things that are keeping it going, and we will have to pivot around again. And I think we may be in an environment in which markets move around 20% at a clip, up and down, and you don't get real resolution for a while. So I think in some sense, the optimism is right because the news has turned, but will it remain that way for a while? I think we're much more likely to be in a volatile world.
Allyson, more upbeat today than 3-6 months ago?
Welcome to myself. Thank you for being here. Thanks to all of you for your participation here. I too am surprised by the optimistic mood that we're finding here. So I'm better at asking questions than I am at answering them. So I have been asking people what is driving this optimism. And the easy answer is the Bloomberg terminal, because when it's green we feel great and optimistic, and when it's red we get very pessimistic about things, which I think is part of it. But beyond that, some of the things that I have heard are perhaps some, and I don't know whether or not this is misplaced, optimism versus last year certainly around Russia's 2022 invasion of Ukraine, and perhaps having not played out the way people expected, which was sort of in a week this will be over and we will have seen Russia's great might. So maybe there, with more visibility there, that's provided some optimism. I think also having a stronger read on what the impacts of higher rates are and are having. I know that we were certainly concerned about vulnerabilities in the financial system with a rapid increase in rates like we have seen in the US. And I think that didn't materialize the way that it could have. And obviously, the swinging in sentiment from we're going to have a deep, dark recession in the US to, oh, actually, maybe not. Who knows? Like Dr. J said, we're going to be battling that. I think it's true. We should expect more volatility. We should be expecting China to continue to be the growth driver. And I'll leave it there in case you have other questions or people you want to talk to.
And Bill, China, we're possibly underestimating the opening of China and the impact on the rest of the world.
Yeah, I think that's the big news of the week. And Li He's speech, I think, was an important moment at Davos this year. And I think it highlights the fact that China opening up and potentially returning to 4% plus growth really is a strong positive for the global economy. And I think it's leading to a lot of optimism this week. I mean, a lot of us had been expecting that zero COVID would end in China, but it was going to happen much later in the year, after the March party meetings, after Chinese New Year, and would happen a little bit like they approached Hong Kong in a graduated basis. And the fact that they did it so quickly and so decisively, I think is going to, and really highlighting a clear pivot towards economic growth as the priority for the party, is a positive for the global economy, and I think it also for investors.
Positive for the global economy. China expected to grow at about 5% this year. Marcus, what does that mean for the rest of the world? I mean, give us a sense of what that will translate to.
Well, it's a pleasure to be here, and I think the question is about China, but it's about something that's more structural and I think more consequential, because even for a tough year like 2022, we're looking into 2023. If you take into account the so-called G7, right, the 7 traditional mature economies of the world, they have a combined GDP measured at purchasing power parity in terms of about $50 trillion. Whereas if you consider what I like to call the E7, biggest 7 emerging economies of the world, so China, India, Brazil, Indonesia, Russia, Mexico, and Turkey, they already have a combined GDP measured at PPP of $60 trillion. So about 20% bigger than the G7. So if a country like China, for example, that's edging closer to having a nominal GDP of $20 trillion grows 5%, it means that the incremental contribution of China to the setup of global demand is $1 trillion a year. That is a huge number. If that number alone, right, was the annual GDP of a country, it would make it to the G20. So that's how relevant it is. And I think, for example, when it comes to expanding trade and investment, even within the emerging market space, the impact is huge. I am from Brazil. Back in 2002, Brazil-China trade was $1 billion a year. Now Brazil-China trade is $1 billion every 60 hours. So it's a very impressive phenomenon, and it's structural. It is here to stay. Emerging markets will have a bigger and bigger slice of the global GDP pie.
Before we talk about the investment opportunities, 2022 was about quantitative tightening, QT. 2023 is about living with QT, and nobody really knows, not even the Fed, how that's going to play out. How will that play out, Jeff?
Well, I think even before QT, the fact that all of us now have to face 4% interest rates as opposed to 0 is very consequential, because we've spent 10 years living in a zero-rate world, and we've developed our business models, developed our investment processes around that. So just think of real estate. We used to think, oh, I should put as much leverage as I can because I can borrow so cheaply. So long as my yield is 5%, it boosts my returns up so much. Now your yield is just equal to, or maybe even less than, your borrowing cost. So if you take leverage out, suddenly what used to be a kind of a brainless investment is suddenly one you have to question. So I think whether it's in paying mortgages, whether it's in investing in leveraged models, whether it's private equity, which has a model that requires leverage, I think all of those will be impacted. And then when QT takes its place, I think one of the things that is not well researched, not well understood, is how much the liquidity environment really helps facilitate, drives financial asset investments and circulation. So I think the safe thing would be to say, well, if QE was so positive, QT at the very least is kind of neutral to negative, and I think we have to watch for that. Maybe we'll see some models that will benefiting from that actually get very challenged.
How much of that risk is already priced into the markets, Bill?
I think the markets are pricing in 75 to 100 basis points more rate rise, with the feeling that inflation's moderating, and we'll be able to really get through the rate rise at that point. But I think what's very early, picking up on Jeff's point, is the QT is just getting started. The Fed really did not reduce its balance sheet that significantly in 2022 and has a long way to go. And I just tying that back to something that you asked, Haslinda, was around the level of debt around the world. I mean, nearly $32 trillion in the United States. You have a highly leveraged global economy as well. And I think we don't really understand all the implications of higher rates, the return of a real rate and even another 7,500 basis points. But I do think you're starting to see the end of the rate rise, at least out of the United States.
Allyson?
Well, I represent a U.S. large pension plan, pension fund, and I think you're hitting on our major theme for next year, which is challenging our assumptions, and that's basically what we're doing. Howard Marks wrote a piece a couple of months ago called Sea Change from Oaktree, talking about the end of the 40-year decline in interest rates and how unprepared all of us are. So I don't think I can answer the question, but I can say we have a perpetual investment horizon. We have a portfolio that is built for a high growth, low inflationary environment. We certainly were helped by this decline in interest rates. We're almost 50% private markets, so that's real estate and private equity for us, which has obviously benefited from the decline in rates. And so our job is to say, now that we have a clear regime shift, or we think we do, it's not the first time in my career where we've been wrong on that assessment, if we had turned out to be, but it seems clear to us that we have shifted from a globalization environment with low rates and everybody's going to benefit and be lifted out of poverty, and therefore we'll all end up happy in the end, to one where security is going to be the paramount concern, which means we have to think much more strongly about how geopolitics and domestic politics, in our case, play into the investment portfolio. And I didn't mention it before, but this is a place for optimism, I think. I'm actually really excited about, rather than having a portfolio that is singularly pegged to central bank action, there are a lot of other factors driving returns, and we hope that we're going to be able to make a difference there.
What will it mean for the BRICS nations?
Well, there's something that Allyson mentioned that I think it's worth focusing a little bit on, which is the changing nature of globalization. I think globalization is not over, it's just that it's evolving. And I mean, if you trace back to the fall of the Berlin Wall all the way to the Great Recession of 2008, more trade, more investment, less barriers. This was, say, the mantra, right? This deglobalization risk that we're feeling in our skin so strongly over this past 2 or 3 years actually began, as I look at it, back in 2008. So what's happening now is globalization is entering a new chapter. And one of the key characteristics, Haslinda, of this new chapter is, one, emerging economies will have more of a role in promoting global growth than before. The trade and investment agreements that are so central for business to play out is going to have a different kind of architecture. It's not only going to be about tariffs and quota, it's going to be about standards, how you approach the environmental question, how you approach intellectual property rights. There's another characteristic in globalization, which is this change, this metamorphosis of infrastructure where the physical and the digital, the tech intensive are coming together. And there's also the issue of talent becoming the most important factor of production. So in each of those 4 characteristics, the BRICS represent a great pool of talent, a great source of growth. They are engineers of this new trade and investment agreements that are being shaped out there. So I think I don't want to add too much to the optimism, but I think there's an upside to be seen there.
All right, some realism here. Higher for longer. Right? I mean, whatever the Fed does, whether it pivots or not, it will be higher for longer. In such a circumstance, Jeff, what do you own? Where do you invest? Will it be things like real estate, for instance?
Yeah, so I think, if it's really true that it's higher for longer, it'll mean that we've
What do you mean if it's true? Are you not anticipating higher for longer?
Well, I think the market is pricing in a decline in rates, and that decline in rates will only come if we have a recession, right? It's because a recession causes enough pain that the Fed pivots its focus away from fighting inflation, getting it down to 2, to there's an economic problem. We need to make sure that employment doesn't drop too quickly. But let's say
your base case. What is your base case?
My base case is I think the market smells something, which is that usually when recessions happen, you don't see it, the data is ambiguous until it really happens. You hit some kind of a wall, and the company starts saying, I've got to lay off people, I'm no longer getting the revenue increases I want, I need to cut my costs to maintain my profits, and that kind of snowballs into itself. Usually that happens very suddenly. It's not happened yet, but it's not atypical even going into a recession. But if rates were to remain at this level, then in some sense, what used to be cash, is now something that offers a return that at least is significantly better than it was before. And I think today we are having quite a tight liquidity squeeze in many markets. And so people can't borrow at banks and so on, and the rates at which you can indeed lend are now significantly higher. So, particularly outside of the public markets, there are borrowers who are able to pay 9-10% for senior secured borrowing. And so I think those are things which are opportunities today, and the higher for longer means you're still worried about the people who have business models that require low rates, but there is new lending that is paying these rates, and you need to go and look and access for them.
Bill, where should smart money go?
Well, we've talked a lot about regime change, like Allyson mentioned. That's the word we've been using, that investors have to sort of step back and factor in a real rate of interest, which we haven't had for a while, and actually a higher nominal rate, and what that means for risk assets. And even inflation that may be stubborn and stick at 3-4% for a while. And again, that's a very different environment than most of us have invested in for at least the last decade, if not longer. So you've got to sort of rethink what that means in terms of how does credit fit into a portfolio, and other assets related to that, and what does it mean for equities? Our view is that you're going to have to tap into secular growth in areas like technology, life sciences, healthcare, energy transition that can drive long-term growth and drive long-term returns, even in that kind of an economic environment. Again, Allyson said it too, riding the interest rate curve and the decline in interest rates as a way of making money will be much, much more challenging in the time ahead. So I think people do have to adjust their investment strategies for what will be, I think, a very different economic reality.
Allyson?
What was the question?
Where do you see the opportunities in a high inflation, high rate environment?
Well, again, we have a portfolio that is invested in that we can't shape very quickly because we don't get it back for another 10 to 15 years before we redeploy it. So from a long-term perspective, I think all of the things that Bill just mentioned are important. Think about the sectors, think about the countries, think about these environments we're talking about, think about your level of concentration, where you're going to find your diversification. If you were to ask me what went wrong last year, obviously diversification was for stock bond diversification was one of those things. I think commodities are an area that have been underinvested in for a while, at least in my part of the world, excuse me. I think that's an area that with security replacing the way we do globalization, I think we have to be looking there. We love real estate. That might just be sort of a perpetual belief that we maintain. I think we like it at all interest rate levels, but we'll be challenging that assumption as well.
You like real estate too, don't you, Jeff? I mean, that's how GIC has been investing, taking shelter in real estate to counter inflation.
Yeah, no, I think that's right. We're not sure, even if the Fed is successful, that you can actually get back to 2%. But let's say, 3% becomes more endemic and so on. There aren't many assets that really can always kind of beat inflation. Maybe equities, chosen correctly can. But certain types of real estate where there is demand, and you're filling up your vacancies, usually you can raise rents in line with inflation. And likewise, in a lot of infrastructure investment, you have some inflation tying in your rent, your yield assumptions. And so I think that if you're worried about inflation and bond yields even at 3.5 doesn't really offset a lot of inflation, then I think you will continue to go out the illiquidity curve and look for those assets.
Marcus, you're looking at building resilience in the BRICS nations. How are you looking at it, and where should investments go? maybe in terms of infrastructure?
Let me connect that with your previous question as well, which is a very good one. I was at the fall meetings of the Washington-based institutions last October, and when you are in an environment like that, generally the questions that are debated are, emerging market debt and the outlook for the global economy. But I was really surprised how omnipresent the discussion on food security was. So if I was to summarize the answer to your question in 2 points, I would say investment in food and water. This is something that is structural, because to go back to my earlier point, if it is true that the greatest driver, the most important engine pushing economic expansion forward will be the emerging economies, think of a country like India with 1.4 billion people. By the way, 2023, 2024 are the years in which we're going to be eyewitnesses to a change in which India overtakes China as the world's most populous country. If India's GDP per capita is $3,000 a year, India grows at 7% a year. In a decade, that means it's doubling its income per capita. What history and literature tell us is that incremental income goes more than anywhere else to the consumption of food, right? So think about 1.4 billion Indians, the 1.4 billion Chinese, you think about 350 million people in Indonesia, all of these countries experiencing robust growth out of reasonably low GDP per capita. So there's going to be a major increase of food consumption in the world. And of course, needless to say, the single most important input in the production of food is water, right? By the way, just very briefly, the other day I was telling a friend that I hoped the trade between Brazil and India would augment a lot. He says, absolutely, I think the India-Brazil trade has everything to be the biggest water trade in the world. And I was asking myself, is this like a technical term that I don't know, water trade? He says, yeah, because you see, out of 10 liters of water that we use in India, 8.5 go into agriculture. So if we open up our markets and import more, then we're saving water for other ends. So anyway, water and food are perhaps the single most important investment opportunities, even from the perspective of infrastructure in the world today.
In terms of geography, it does feel like when you take a look at the trends, onshoring, friendshoring, and also when you take a look at the growth, India expects to grow at 7%, the Philippines 7%, Southeast Asia, and speaking of India, it's expected to be a $7 trillion economy in 7 years. It does look like you have to be invested in Asia, in Southeast Asia. Jeff?
Yeah, I would agree. I think that the Southeast Asian countries and many of the emerging markets that have been talked about really should be able to grow. The only question is, how do you invest in them? What are the things that will benefit from the growth? And what we've found with emerging markets over the last 10 years is two things. So one is that growth doesn't necessarily translate into earnings growth, into earnings per share that you can really benefit from by investing in stocks. So it's company by company. You can escape that, and you want to do that. But the second is that these are historically countries that have macroeconomic control that isn't so great, and you go through these cycles. So catching them at the peak of the cycle and then finding you have to sell them at the bottom of the cycle is not good investing. And so I think we need to be careful for that. But I think one thing, if I may, is that many of these countries are now adopting technologies and are leapfrogging, if you will, in the adoption of technologies. And so there is an opportunity, I think, on the digital side, on the growth side, that 10 years ago we wouldn't have associated with emerging markets, but it's very much associated with emerging markets today.
I just would like to comment. I mentioned commodities earlier, which includes food and probably not water for us, but I guess I would just contrast that with the opportunity set with the comments we heard earlier, one about the Fed's balance sheet. I think we definitely need to keep an eye on how they are looking to reduce it, because that could create issues in emerging markets. And back to globalization looks different now with security concerns, and I think food security is just as important, obviously, around the world as energy security. So those would be the areas where you'd want to be cautious, I think, but otherwise, you'll sort through that and figure out the attractive opportunities within the set.
You're just picking up on that, and what Allyson said earlier about commodities. One of our chief economist, Mike Spence, has, I think, put a good framework on it. It's been very helpful to thinking about it. But if you look at the last 20, 25 years, we've had a world where really across the board you had excess supply versus demand, whether in a lot of commodity areas, food, labor, that was brought in, particularly from the Asian economies, most notably China. And so you had this world where excess supply, deflationary pressures, benefits of globalization, and it really feels, in his view, we're at a sea change where demand is exceeding supply almost across the board. The dividend of all that labor coming in is at its end. In commodities, we're also are in tight supply, led by oil. We all know what just Jeff mentioned it before, but $10 increase in oil since China opens up. I mean, that's a 1.5 billion barrels a day when they grow at 4% versus 0 to 1%. So very, very tight. So I think this framework of a world where demand exceeds supply in lots of areas. What does it mean for inflation? What does it mean for investable assets? Is something to think about.
I think China's foreign minister was in Africa last week or earlier this week. I have no idea what time zone I'm in or where I am, what day it is. I think on this topic, looking to secure, oil contracts, and obviously there's an interest in pricing those in their local currency instead of the U.S. dollar. I think that's something to pay attention to as well.
I think, if I may comment though, water shortage, which is very real already. I mean, the water tables in India and a lot of places where a lot of agriculture is currently conducted has dropped tremendously in the last 10 years. And so you're running out of fresh water for agriculture already. But it's not something that the markets can solve very easily, because water is not priced really by the markets. It's municipal. It's sometimes it's priced badly, and so I think there is a real public policy crisis around water and therefore for food security, which I hope we will address quickly. But that's something that isn't necessarily top of mind immediately.
May I jump in? Mm-hmm. China imports a lot of soybeans, and it tries to produce a lot of corn domestically. Do you know why? Well, it's because for every ton of soybean production, you need about 5 times the amount of water that you need for a ton of corn. So, for example, you look at a country like the U.S. or like Brazil exporting to China soybeans. It's not soybeans. You were exporting water. Right? So what does that tell you about infrastructure for improving the efficiency of water in Brazil? It tells you a lot. So I think this is the kind of connection we should establish between, it goes beyond, say, the perspective of these items as only commodities, but it's infrastructure on the ground that creates extraordinary opportunities and that creates a multiplying effects that you can see on trade.
I want to touch,
I was just going to say California is a massive water exporter if you look at it that way, and they're having water issues. I just remind us water is a political asset, so you just have to be careful.
Yeah.
Yep, I come from Singapore. I appreciate that. I want to talk on the Chinese market in particular. Not too long ago, people were extremely pessimistic and now extremely optimistic. How do you look at the Chinese market? It is back being investable, but what does it mean? Are there sectors you want to look at, sectors to avoid? How are you looking at the Chinese market and how to invest in it? Bill.
Well, we've stayed consistent in our focus on China. And
what is that?
Well, focus meaning we've considered it investable the whole way. We never came to a view that China was uninvestable. We said for an economy of this scale, and we see it as an innovation economy today, not just a manufacturing export economy. And so our view was we wanted to be exposed to China for the long term. Now, we recognize that geopolitical risks were elevated, and they'll probably remain elevated. But what we did do was shift our strategy towards what we call China for China, which basically companies that were serving the domestic market. So rather than companies that might be more export-oriented. It was more services-based, healthcare, consumer, retail, that were benefiting from domestic growth and probably a shift towards consumption. And that's consistent with the government's policy to try to rebalance our economy towards domestic consumption. So we wanted to get aligned with that. And we thought that also just reduced our exposure to the geopolitical risk of what was going on between U.S. and China. But I think for any global investor, we talked about the scale of the Chinese economy. We talked about the scale of its growth. I mean, I think it'd be a mistake to ignore that opportunity and not invest the time and effort to find those opportunities.
Other sectors you're avoiding in China?
Well, I think there's ones that will always be sensitive. Financial services is a challenging place. The large banks, policy banks that are partially state-owned, play a very, very important role, and it's hard for innovators to really be successful like they are in many other parts of the world and many other emerging markets. So it's not an area that we prioritize in China, for example. Conversely, life sciences innovation has really improved. That's I think a real bright spot. With a lot of R&D going into that area. We see a lot of opportunity in life sciences, but I think things, of course, media is something that we've never, is really, more or less off limits, and we don't pay any attention to that.
GIC, of course, has exposure in China, significant exposure, especially in tech.
Yeah.
Is the worst over for tech in China?
I think there was a little bit of confusion around, what is the real regulatory stance that China wants to take on, whether it's super huge tech companies. Maybe they did think it was, they were too big, monopolistic, and so on, and they needed to curb them down. Maybe they were pushing in areas that were socially sensitive, whether it's gaming or education, and they would curb that. So I think there was a long period where there was some considerable regulatory uncertainty. I think part of what Liu He was saying yesterday was that they've kind of solved all of that now, or they've kind of decided, shown the limits of where they want to curb the competition, and now they're sort of saying, okay, we'll let some of these companies then go back to the businesses that they're in, subject to these now kind of telegraphed constraints. So I think Chinese tech, in the big tech, that picture has become clearer. But Chinese innovation isn't just in the big tech companies. There's a lot of on-the-ground innovation, including in areas like software and so on, which aren't kind of fully mature markets yet. So I think there are a lot of opportunities. We work with Bill's company as well as with other investors to go look for them. And I think the one thing I really like is this idea that China can grow a major economy every year. So the fact that you invest in a small company that could essentially grow to Indonesia's size in 2 years or 3 years means that there's a lot of growth that you can benefit from.
Just back on Jeff's point about innovation, and one area if you look a little deeper on in terms of electric vehicles, green economy, sustainability, China's far ahead in this. They've made huge investments in those areas and have real innovators. And it's another example. People think about the traditional tech companies, but there's other areas that are large. Material science is another place where they're really our global leader. So I think there's a lot to see.
There is a reconfiguration dynamics of value networks or global supply chains, and one talks about decoupling and everything else. But some of the factors that have just been described here show you that perhaps the very own evolution of China's economy is much more impactful in redesigning these value chains than the geopolitical discourse, because of frugal innovation, as it was mentioned here, because China is moving away from manufacturing, going into manufacturing. Back in 2006, international trade as a percentage of China's GDP was 67%. Now it's 35%. The nominal numbers are still very impressive, but as a proportion of GDP, it has come down. So the evolution of big emerging economies, as I see it, is a much more powerful engine in redrafting those supply chains, those value chains, than geopolitics. So you may see decoupling in some areas, but you see neo-coupling things, connections that were never there before.
Allyson?
We're giving a lot of thought to this question. As a U.S. investor, we have to pay attention to the fact that when Russia had the 2022 invasion of Ukraine, it woke people up to the types of actions authoritarian regimes can take, and it changed the political view, I think. China's response to that and how they continue to move forward became a topic. We have to think about, as a global investor, we have to think about whether or not we'll continue to be allowed to invest in China. Right now we have exposure in every single one of our asset classes. It used to be a much larger percentage of our portfolio than it is today. That is mostly market decline over the last 5 years relative to the US, in addition to some selling of positions. I happen to believe the US-China rivalry will be one of the dominant themes of our time, which you and I talked about yesterday, Jeff. Our approach is that we don't think it's very realistic to think about decoupling from China. I know that's what we're talking about, and I know there are policies out there meant to think this through, but they are dominant in virtually every area that matters. Global supply chain. They're a massive producer of basic components. I know the US is now targeting the higher end on semiconductors. They're dominant beneath that level in virtually everything we buy as consumers. But there's a trust factor there that we have to think about, and we have to try to anticipate the political winds as a US investor, speaking only from that perspective. So we want to be part of the growth. We want to maximize our returns at a prudent level of risk. And if I may add on to this point, one of the other areas of concern is that the approach to risk management in general appears to be changing. And anybody feel free to disagree with me on this, where we went through a period of time where at the right price you could justify a certain level of risk. Given the security dimension, I think, and the political dimensions that we're grappling to figure out, now risk management has a little bit of are you in or are you out? That's not the best dynamic for a broad, global, robust investment portfolio. So we hope to find diversification, we hope to stay invested, and we hope to make money for our beneficiaries.
But before I open the discussion to the floor, just on ESG, we have indexes, governments getting stricter when it comes to criteria. What benchmarks do you use, Jeff?
We look at a range of them. I think we don't subscribe to a kind of an ESG index and then kind of sort of say, well, we have to manage towards that. I think what we are trying to do is we know we are in a crisis. We know that significant measures need to be taken, and to the extent possible, if we can invest in companies that are helping to make those steps, help those steps to be taken. It's applying the technologies that help to reduce, increase energy efficiency or change the energy mix to be cleaner. You want to invest in that. If there are capital expenditures, sometimes subsidized by government, sometimes not, that really are needed. We want to be providing capital to put those capital expenditures in place. And I think by doing that, we feel that you actually have an impact on the overall emissions. Whether that's necessary, at least as far as climate is concerned, whether that's necessarily captured by any index that we would want to subscribe to, I'm not so sure. So I think we're trying to look at it from that fundamental bottoms-up point of view in terms of what we're invested in, rather than trying to stick to an index. Although we of course subscribe to them, look at them, try to measure ourselves against them, and to see whether or not they are in fact good measure.
Let's open the discussion to the floor. If you have a question, just raise your hand, and I think a microphone will come your way.
Great session, by the way. In the discussion, though, we've heard. Let me turn on. You guys have talked about people are going to be spending more on defense, security. Things like water are going to be more scarce. China's coming back online, increasing energy cost. Hit on a little bit ESG, but there's going to be a lot of green infrastructure spend. What is this disconnect? It feels like inflation is going to be elevated. I mean, that's a lot of spending globally with more scarcity on key ingredients to the global economy. And then kind of to your point on where it feels like the market's pricing. Do you guys have any view on what that disconnect is?
I think,
Go ahead.
well, I don't know. I'm sorry, I dove in there. I think it's back to what we were talking about, the fact that we're used to a world where we have excess supply, and we're just getting used to a world where the resources you talked about are in short supply and in high demand. And that plus the other part of your question, I think, is elevated geopolitical risk. We all talked about it, but you know, we lived in a period of time where geopolitical risk was down the spectrum in terms of risk management. Now it's the top of the list. And those are big shifts for investors like all of us to sort of incorporate into our strategies. But those are, you know, big changes I think will define the environment of the next decade plus.
Just perhaps to add to Bill's remark, one of the key elements in keeping inflation at bay over the past few decades was the expansion of globalization, right? And we have been living a sort of globalization intermission for many different reasons, COVID, of course, being perhaps the most important one of them. But there are also, I mean, some underlying news there actually perhaps make us closer to an optimistic approach. The U.S.-China trade numbers came out, I think, the day before yesterday. $760 billion of bilateral trade, which I think is a record level. I mean, if 2023, 2024 are years in which we see international trade picking up again as a driving force for global for GDP, this will help bring inflation down.
Thank you very much. I have a question on China, actually. It seems like the euphoria sort of coming from China, that was like the big. What are the downside of it? Because even though they open up, you know, there's since it was such a big U-turn or a V-turn to from this stringent zero COVID policy, and there's so many infection and unpreparedness, there's so many downside on that part, and then China is not growing as fast as in the past. So the contribution to the global economy will not be as large as in the past, given the lower rate of growth. So would you please sort of talk about the downside or the not only a positive scenario of China opening up, the negative scenario of China coming back?
Well, I'll start and then you all can jump in to flesh it out. Well, I mean, I think the obvious downside, I don't mean to sound trite, is that this is sad. I mean, there are infections just, when you hear a headline that says, well, this will be over in a couple weeks, and there are statistics like 90% of our employee base in Shanghai is positive for COVID. I think that there's relief that it's not as severe as we saw early on, but then obviously with people traveling back home for celebrations, bringing it back to the more vulnerable people. To me, that's just, I worry about that. That's a downside for sure to the opening up. I also think, Bill made this point earlier, I'll just double down on it. The reversal of this, deflationary period, I think through whether it's declining population or more expensive labor in China and looking for ways to friendshore, onshore around the world, I think that we're going to see a lot more friction in the system. And I don't know that we're mentally prepared. Back to challenging assumptions. I mean, that was a massive, massive trend, tailwind, whatever you want to call it.
I come in. Yeah, no, just on the issue of proportions scale. 20 years ago, China was growing 10, 11% a year, right? But it was an economy the size of Italy, $2 trillion. So if you're growing 10%, on the basis of $2 trillion, your incremental contribution to global GDP is $200 billion a year. If you are a $20 trillion economy and you're growing at 4%, your incremental contribution is, I'm not talking about inflation here, but I mean, just number to number is 4 times bigger than that 20 years ago. If China stabilizes at 3.5% growth over the next decade, the very interesting phenomenon you will see is that either China or the US will be the top GDP in the world. Either China or the US would be the second. But the third will be the result of this incremental growth in China that will overtake Japan's GDP today, which is the third biggest economy. So the impact of China, stepping back on the stage of global economy is huge.
One thing that makes this whole conversation so complicated about China and complicated for us as investors is how globalization is changing in the future. And I'm thinking about one of our companies. We have a company that is the largest global manufacturer of biologics. It's based in China. It's about a 40% global market share. And a lot of their production today is in China, but they're building facilities all over the world, United States, Europe, everywhere. Within 4 to 5 years, they're going to have 60% of their production outside of China. So it'll be a China-listed company, a China-domiciled company, but it'll be a global company, and it'll be a global leader. And the same's happening with the battery providers there. If you talk to the battery companies where they've had a real global lead, just like they did in pharmaceutical manufacturing, they're quickly diversifying themselves out of China and building plants in other parts of the world. And so for many of us, it'll be a Chinese investment, but it'll be a global company. So you have to think about that too. It's not so straightforward.
We have run out of time, but I know we have another question here. I know Sarah, so I have to let her speak.
And I'm going to use my Young Global Leader allowance as well. Hi there, my name is Sarah Jaensubhakij, Young Global Leader, and also co-founder and managing partner of the $1 billion Fund for Women, Beyond the Billion. My question is, you talked about pricing risk, and you all represent institutional investors that have driven a lot of the venture capital funds, right, that are investing into the future technology. And what we're seeing with the compression, the wipeout that we're continuing to see between 2020 and 2021, right, the tech valuations have been slashed. There's a lot of blood on the streets that we're seeing. What is your view on venture capital as an asset class moving forward? And are you going to continue to double down on ESG and your views on integrating all of this?
I think, as you know, in 2021, the amount of venture capital money that was invested was, I think, 4 times the average of the previous, 5 years or something like that. And there are only so many good ideas that can be funded at any one time that will make you money. And so clearly, and investors, ourselves, as well as the venture firms and the growth firms, we only have ourselves to blame because, all those things we know. And so the fact that we're trying to push all that money through one funnel is our own fault. I think we are much chastised. We are thinking much more soberly. And, I'd be surprised if any of us are not setting much higher bars around, at what point will this be commercializable, monetizable, and so on. And I think the pivot to thinking about ESG type technologies that serve the ESG purpose, I think is very, very real. And there are a lot of opportunities there that have not received the funnel of money yet.
We made our first venture investment in 1980. It was the first private investment that we made, actually, with one venture firm. We've invested in every one of their funds since and done nothing else. So we have a very, very small allocation to venture capital. We're just too large, and we don't do it direct. We instead, as companies mature, we pick those up through our other asset classes. I think there will always be appetite for venture. It's where a lot of innovation takes place. I'm just going to mention that there's a book called Brotopia that you may be familiar with that a Bloomberg journalist, Emily Chang, wrote that you don't have to agree with everything in it, but I think it's worth reading.
It has, go ahead.
I'm not associated with it. I would just say it was a good book.
Yeah, it is.
Yeah.
I'm sure you'll agree it's been a fascinating discussion. Please join me in thanking the panelists today. Bill, Marcus, Allyson, Jeff, thank you. And thank you for joining us.
Thank you, Allyson.
Thank you.